Have you ever wondered why prices move? Who actually moves the prices, and how can we take advantage of price movements? In this session, we will discuss the concept of supply and demand, or as it's known, the smart money concept. Without further ado, let's get straight to our first question: what actually causes prices to move? Prices move due to the law of supply and demand, which is the relationship between the amount buyers are willing to pay and the amount sellers are willing to sell at any given time. The accumulation of sellers entering the market represents the supply, while the accumulation of buyers entering the market represents the demand. If there is an imbalance between the buyers and sellers, the price will move accordingly. For example, if the amount of buyers entering the market is greater than the amount of sellers, the price will rise. Conversely, if there are more sellers than buyers, the price will fall. Now, who are these buyers and sellers we are talking about? We are not referring to retail traders like us who engage in buying and selling actions in the market. The number of retail traders is too small to significantly impact the market. Instead, we are discussing the big players, such as major banks, institutions, or commonly known as market makers. These entities execute buy and sell actions in the market, often causing significant price movements such as changes in support and resistance levels or impulsive price movements. Due to the large size of their transactions, their actions create imbalances in prices, or what we can call imbalances. As retail traders, it is advisable for us to search for traces and signs of transactions made by these major institutions. We should align our trading and opening positions according to their movements and the outcomes of their transactions. We can observe the actions of these market makers in the chart and search for opportunities based on their transaction traces. So, where can we find the trace of these market makers in the chart? In this video, I will share 3 areas of supply and demand in the niche market. I recommend not skipping this video till end as it contains fundamental knowledge and information. This will help you master supply and demand strategies. The first important aspect is reacting to support and resistance levels. A significant amount of transactions is needed to change the price direction and form support and resistance levels. This is one of the traces left by market makers that we can analyze. For example, in the chart, we can see the price forming a resistance level. Initially, the price moved upwards, but then it was pushed down from this point, indicating significant selling pressure. Hence, we mark this area as a supply and demand zone based on support and resistance. To mark it, we start from the end of the candlestick body and the tip of the candlestick wick. However, we should not immediately enter trades based solely on support and resistance areas. We need to wait for candlestick patterns, momentum candle, or confirmation, which I have shared in a previous video on this channel. So, for those who haven't watched it yet, please do so after watching this material. And then we can see the price rise from here, indicating significant buying pressure that pushes the price up and breaks through the previous resistance level, turning it into a support area. Then, it moves in and out, pushing the price back to a similar point. So, we will mark this area as a new resistance. Now, pay attention to what happens here. We can see rejection candle, which means a demand starting to enter the market and pushes the price from here. Then we can see a green candlestick, and indirectly, this pattern has formed a bullish engulfing pattern. Furthermore, the green candlestick indicates strong buying momentum and the price will rise, breaking through this resistance level. Finally, this resistance now becomes support. Next, the price rapidly moves up and down from this area, indicating significant selling activity in this zone and pushing the price back to the support area. Now, observe carefully what happens in this area. A shrinking candle start to forms, indicating that sellers are weakening and the buyers start entering. and a green handle is formed, creating a bullish engulfing pattern. Then, the strong green candle form and this become a bullish engulfing pattern. After that, another green candle form indicate that demand are so strong now, and subsequently, the price rises and meets the supply zone again. Notice that the price reverses from there and starts pushing the price up again, only to fall back to the support level. Now, pay attention to what happens here. Buyers enter again, and the price continues to drop, resulting in a long-tailed candlestick in this area, indicating a battle between buyers and sellers. Then, from this point, more significant selling occurs, pushing the price down rapidly, breaking through several levels. This indicates a strong supply on this area. So, we mark this area as a supply zone and observe in this demand area. The price forms a rejection candle and engulfing, then price rise toward this supply zone. And here, price forms a shrinking pattern, indicating weakening buying pressure, and sellers start entering. Finally, a bearish engulfing appears, indicating that sellers have won the battle, and the price falls again, and so on. Next, let's discuss the supply and demand areas based on the concept of rally-base rally and drop-base drop. Perhaps you have already heard of these patterns. In the rally-base rally pattern, the price initially rises, then consolidates before experiencing a rapid ascent, forming a rally-base rally. On the other hand, in the drop-base drop pattern, the price falls, consolidates, and then drops rapidly. However, in this case, I will replace the terms rally-base rally and drop-base drop with order block areas. So, the conditions for a valid and high probability RBR, rally-base rally, and DBD, drop-base drop, are as follows. First, there must be an imbalance after the base formation, and second, it should be accompanied by a break of structure or the formation of a new high or low. Now, let me explain this on the chart. To find RBR and DBD areas, first, you need to identify the imbalance area on the chart. How do we recognize the imbalance area? We can identify it by looking for candles with very strong movements. If you observe that the tail of the first candle does not touch the tail of the third candle, it indicates an imbalance area. This means that there is significant demand that overpower the sellers, causing a price jump and forming an imbalance area based on this candle. For example, here we can see the price moving up from this level, then it consolidates sideways and forms a base, indicating that sellers are entering this area and halting the price from the previous demand. However, larger demand enters again, creating two imbalance areas simultaneously, indicating a strong demand from this point. The strength of this demand pushes the price to break and surpass the structure of the price, which is called a break of structure. So, let's summarize what we have here. First, the price shows an uptrend structure, indicated by higher highs and higher lows. Then, there is a break of structure that creates a new higher high. Additionally, we observe a rally-base rally pattern followed by the imbalance areas. We can place a buy limit order in this area and set the stop loss slightly below the demand area. For take profit, we can place it at 75% of the previous highest point before the price returns to the demand area, or you can use a risk-reward ratio of 1 to 1.5 or 1 to 2, and so on. This trade ends with a profit. Then, here we can see the price experiencing another break of structure, and in this area, we can observe two rally-base rally patterns followed by imbalance areas. Additionally, we can see the price bouncing off this area. For drop-base drop, it is the opposite. For example, here the price forms a downtrend structure with lower highs and lower lows. We can see a break of structure in this area. Then, in this area, we can see the price forming a drop-base drop pattern, where sellers push the price down, then buyers enter and attempt to push the price back up. However, larger sellers enter, causing a significant movement and forming an imbalance area in this zone. Therefore, we will mark this green candle as the base candle, as significant supply enters from this base area. We will enter a sell limit order in this DBD area, and for the stop loss, we will place it slightly above the base area. The target profit will be 75% of the distance from the lowest point before the price reverses towards the DBD area. This trade ends with a profit. Area supply and demand that come next is the order block, which is one of my favorites. An order block is a candle that precedes an impulsive price move. For the demand area, if the price is moving up, the demand order block is the last bearish candle before the increase. Similarly, for supply, if the price is moving down, the supply order block is the last bullish candle before the decline. The conditions for a candle to be considered a strong order blocker: first, the order block must create an imbalance area, and second, the price must also create a break of structure. For example, in this chart, we can see an uptrend indicated by the EMA 200. So, we will only look for bearish order block areas or demand areas here. First, we need to identify the imbalance area. In this example, we can see an imbalance area accompanied by a break of structure, and before the imbalance, we can see the last bearish candle. This candle represents the demand order block, and because we are in an uptrend, we will only focus on identifying demand order blocks. Then, we can see another demand order block, where the price creates an imbalance and a break of structure. This is another order block area. Notice that the price bounces off this area, indicating demand at this order block. We can also observe an imbalance and break of structure below this candle, followed by an order block candle. The same goes for this bearish candle. Notice that the price always attempts to reverse direction from this order block. Let me explain what actually happens in this area and why the price bounces from this area. Below this, buyers or demand enter with a significant amount of buying, causing the price to start moving up. However, at this point, sellers enter and try to push the price down, creating this bearish candle. Then, at this point, demand re-enters with a substantial volume, creating an imbalance area and a break of structure. So, when the price returns to this area, it will meet the previous demand that pushed the price up. Now, for the bearish order block, here the price is below the EMA 200, so we will only look for supply order blocks. I will directly mark the imbalance area, the break of structure, and the order block area. Notice that when the price returns to the order block area, it often gets rejected by supply and bounces off this area, indicating the presence of institutional supply. So in conclusion, understanding and identifying areas of supply and demand, such as rally-base rally, drop-base drop, and order blocks, can provide valuable insights for trading decisions. These areas allow us to recognize imbalances, break of structures, and the interaction between buyers and sellers in the market. By studying price movements and analyzing candlestick patterns, we can pinpoint potential entry and exit points, set appropriate stop-loss levels, and determine profit targets. Whether it's recognizing demand order blocks in an uptrend or identifying supply order blocks in a downtrend, these concepts can help us make informed trading decisions. Remember, it's essential to combine these technical analysis tools with other indicators, risk management strategies, and fundamental analysis to form a comprehensive trading approach. Continuously practice and refine your skills in identifying supply and demand areas, and always adapt to changing market conditions. That's it for today's supply and demand concepts in trading. If you found this information valuable and would like to explore more trading insights, tips, and strategies, please subscribe to my channel. By subscribing to my channel, you'll stay updated with the latest content and receive valuable trading information. Don't forget to hit the like button if you enjoyed this discussion and found it helpful. Your support is greatly appreciated. Thank you and bye.